Hyundai India is preparing to hit the markets with an IPO valued at a jaw-dropping Rs 25,000 crores. This IPO is said to be the third largest in the last 5 years following LIC's 21,000 crore and Paytm's 18,000 crore IPO. In this video, we'll let you in all the hidden reasons why this record-breaking IPO is yet another retail trap. As we said, this is going to be the third record-breaking IPO in the last 5 years. In theory, this sounds very rosy, but this statement in itself is a huge red flag of its own. Paytm raised 18,300 crores at a sky-high valuation, but its post-IPO performance has been very disappointing, with stock eroding around 80% of investors' wealth till date. Similarly, LIC's 21,000 crore IPO valued at 6 trillion rupees also faced several challenges. The stock was down roughly 40% from its IPO price within weeks of listing. These cases highlight how record-breaking valuations finally reset themselves after they get listed. It could be different in this case as Hyundai is a very old company with very strong fundamentals. So their own growth story could actually justify the record high valuation. But let's take a look at the entire story before jumping to conclusions. Whenever a foreign subsidiary gets listed in India, one major fundamental metric that you have to keep an eye on is dividend payouts. High dividend payouts can signal strong earnings and a mature business model. However, excessive dividends can indicate a lack of reinvestment opportunities or potential financial strain. For the subsidiary, heavy dividend payouts might restrict their growth, reduce competitive advantage, and increase financial risk if earnings decline. This was seen in the case of Interglobe Aviation or Indigo Airlines. Interglobe Aviation, Indigo's parent company, saw its net worth turn negative prior to its IPO after paying out approximately 80% of its profits as dividends to its promoters. Post-IPO, the stock saw a major correction and many retail investors were trapped in it. Coming back to the Hyundai IPO, based on the draft prospectus, Hyundai's South Korean parents have been milking them dry. In March 23, Hyundai India's dividend nearly tripled year on year to its parent company to over 4,600 crore rupees. So basically, the subsidiary had to pay out all of its profits to the parent as compared to half the profits a year before. It gets even worse in March 24. The dividend payout was about 11,000 crores, whereas their profits were only 6,000 crores. So basically, the subsidiary had to use its accumulated reserves to pay out the dividend. Adding to the intrigue, Hyundai India's royalty fees to the parent company has been raised from 2.25% of revenue to 3.5%. Royalty payments are the price Indian subsidiaries pay for using their parent company's intellectual property, and this can be a double-edged sword. On one hand, they grant access to valuable technology and brand power. On the other, they can drain profits like a vampire sucking blood. To navigate this, subsidiaries must strike a delicate balance. They need to ensure that these payments align with the true value of the intellectual property while preserving their own profitability. In the case of Hyundai India, it looks like the management is stuck with a very bad deal. For the financial year ending March 31, 2023, Hyundai India shelled out 14,350 crore rupees in royalty payments, a 30% hike from the previous year. This fee is based on revenue, not on profits, and it puts a significant dent in the company's profitability. While the massive dividend payouts might stop post-listing, the increased royalty fees are here to stay, potentially affecting long-term financial health. Despite these concerns, Hyundai's strategic position in the booming Indian market is undeniable. India now ranks as the third largest car market globally, trailing only behind China and USA. Hyundai has made a mark with hit models like the Santro, i10, i20, Creta, and contributions from Kia Motors. The company's growth blueprint includes ramping up their production capacity. Their acquisition of General Motors plant in Pune is a key move to meet the soaring demand. As India's largest passenger car exporter, Hyundai reaches over 80 countries. Plus, the company plans to electrify its future, aiming to expand its electric vehicle lineup by 2030, with Kia starting local EV production by 2025. Hyundai India's IPO is a roller coaster of opportunities and risks. As an investor, it's essential to weigh these factors carefully before making your move. Will Hyundai India's IPO break records and deliver solid returns, or will it follow the fate of its predecessors? Only time will tell. Until then, if you like the content, you know what to do.